Most business owners work hard all year, then panic when tax season hits. They hand everything to their CPA and hope for the best. But smart owners do something different. This video will teach you all about tax planning to manage your business finance before it's too late. Tax planning starts with understanding one simple truth. Taxes are one of your largest business expenses. If you would never ignore rent, payroll, or inventory costs, then you should never ignore taxes either. The first step is knowing your business structure and how it affects taxation. In the United States, sole proprietors report income on Schedule C LLCs may be taxed as sole proprietorships, partnerships, S corporations, or C corporations, and each structure has different tax implications. For example, an S corporation may allow you to split income between salary and distributions, which can reduce self-employment taxes when done correctly and legally. A C corporation may offer lower corporate tax rates, but creates potential double taxation on dividends. Choosing the right structure or adjusting it as your revenue grows can significantly impact how much you legally owe. Next, you need to understand the difference between tax preparation and tax planning. Tax preparation is what happens after the year ends. Tax planning happens during the year. Real tax planning includes tracking revenue monthly, estimating quarterly taxes, managing expenses strategically, and forecasting profit before December 31. If you wait until April, it is too late to adjust income timing, purchase equipment, contribute to retirement accounts, or make strategic deductions. Strong business owners review their profit and loss statement at least quarterly. They look at net income trends and ask, if this pace continues, what will my tax bill look like? That question alone can change behavior. It may push you to accelerate legitimate expenses, delay certain income, or increase retirement contributions before the year closes. Cash flow management is directly connected to tax planning. Many profitable businesses fail because they do not reserve money for taxes. Revenue is not profit, and profit is not cash in your pocket. You must set aside a percentage of every payment you receive into a separate tax account. Many US-based advisors recommend starting with 25 to 30% of net profit, adjusting based on your effective tax rate. International business owners should consult local rates, but follow the same principle. When taxes are separated immediately, you remove stress and avoid using operating cash to pay tax liabilities later. This protects working capital and keeps payroll and vendor payments stable. Deductions are another key part of smart planning, but they must be legitimate and well documented. Common deductible expenses include office rent, software subscriptions, business travel, marketing costs, professional services, insurance premiums, and equipment purchases. Section 179 inches, the US may allow you to deduct qualifying equipment purchases in the year they are placed in service instead of depreciating over time. However, deductions should never be driven by emotion. Spending $1 to save 30 cents in taxes is still spending 70 cents. The goal is to reduce taxable income while improving business performance, not to buy unnecessary assets just to lower a tax bill. Tax planning must align with long-term financial strategy. Retirement contributions to SEP IRA, solo 401k, or other qualified plans can reduce taxable income while building future security. Health savings accounts, research and development credits, and other incentives may apply depending on your industry. The smartest owners treat tax strategy as part of overall business finance, not as a separate topic handled once a year. When you understand how revenue, expenses, structure, and timing work together, taxes become predictable instead of frightening. Now let's go deeper into income timing and expense strategy, because this is where real tax planning becomes powerful. In accrual accounting, income is recorded when earned and expenses when incurred. In cash accounting, income is recorded when received and expenses when paid. Many small businesses in the US use cash accounting because it offers flexibility. For example, if you expect higher income this year and lower income next year, you may legally delay sending certain invoices until January to shift taxable income forward. On the other hand, if this year's profit is lower than expected, accelerating income before year end could help you take advantage of lower tax brackets. The same applies to expenses. Prepaying certain expenses such as insurance premiums, software subscriptions, or professional services before December 31 may reduce this year's taxable income. These are legal strategies when executed properly and documented correctly. Estimated quarterly taxes are another area where business owners often make mistakes. In the United States, if you expect to owe at least $1,000 in taxes, you are generally required to make quarterly estimated payments. Missing these payments can result in penalties and interest, even if you pay the full amount later. A disciplined owner reviews profit every quarter, calculates estimated liability, and sends payments on time. This protects cash flow and avoids surprise bills. International business owners face similar advanced tax payment systems depending on their country. The principle is the same: predict, reserve, and pay gradually instead of reacting at the last minute. Payroll strategy also plays a role in tax efficiency. If you operate as an S corporation in the US, you are required to pay yourself a reasonable salary before taking distributions. That salary is subject to payroll taxes, but distributions are not subject to self-employment tax. The key word is reasonable. Underpaying yourself to avoid payroll taxes can create compliance risk. Overpaying may increase unnecessary tax burden. A balanced compensation structure designed with professional guidance can improve tax efficiency while staying compliant. If you have employees, understanding payroll tax credits, benefits deductions, and compliance requirements becomes equally important. Depreciation is another powerful but often misunderstood concept. Instead of deducting the full cost of certain assets immediately, businesses may depreciate them over several years. However, bonus depreciation and Section 179 rules in the US sometimes allow accelerated write-offs. This can significantly reduce taxable income in profitable years. But remember, depreciation reduces taxable profit, not necessarily cash flow. You must still pay for the asset. Smart owners evaluate return on investment first, then tax benefits second. Consider multi-state or international operations. If you sell across state lines in the US, you may trigger sales tax nexus depending on revenue thresholds. If you operate internationally, transfer pricing, value-added tax, and permanent establishment rules may apply. Ignoring these can create major liabilities later. Good tax planning includes understanding where your obligations exist and registering properly before penalties arise. At its core, tax planning is about predictability and control. When you track income monthly, estimate liabilities quarterly, structure compensation wisely, and understand deduction rules, you shift from reacting to leading. Taxes stop being a once-a-year shock and become a managed operating expense, integrated into your overall business finance strategy. Another important area in tax planning is understanding tax credits versus deductions. Many business owners focus only on deductions, but credits can be even more powerful. A deduction reduces your taxable income. A credit directly reduces the amount of tax you owe dollar for dollar. In the United States, examples may include the Research and Development Credit, Work Opportunity Tax Credit, Energy Efficiency Credits, and certain hiring incentives. If your business invests in innovation, technology development, renewable energy equipment, or workforce expansion, you may qualify for programs that significantly reduce liability. International business owners should research similar government incentives available in their countries. Ignoring credits means leaving real money on the table. Inventory management also affects taxes more than most owners realize. If you sell physical products, the way you account for inventory changes your cost of goods sold and taxable income. Methods like FIFO and LIFO can produce different profit results depending on inflation and supply chain costs. When prices are rising, certain inventory methods may reduce taxable income legally by reflecting higher costs. However, these decisions must align with accounting standards and long-term strategy. Inventory write-downs for obsolete or damaged goods can also reduce taxable income if properly documented. Strong systems and accurate tracking are essential. Another advanced concept is loss utilization. If your business experiences a loss in 1 year, that loss may offset future taxable income depending on tax rules in your jurisdiction. In the US, net operating loss rules allow businesses to carry losses forward to reduce taxable income in future profitable years, subject to limitations. This is especially relevant for startups and growth phase companies that invest heavily up front. Strategic planning around timing of income recognition and use of prior losses can smooth long-term tax exposure. Business owners should also understand owner benefits and fringe benefits. Health insurance premiums, certain retirement contributions, education expenses, and qualified business mileage may be deductible when structured properly. If you use a home office exclusively and regularly for business, you may qualify for a home office deduction under IRS guidelines. Vehicle use must be documented carefully with mileage logs if you plan to claim business usage. Poor documentation is one of the biggest risks during audits. Clean records protect your deductions. If your business operates online or sells digital services, sales tax compliance becomes critical. After the South Dakota v. Sex Wayfair decision in the United States, many states can require out-of-state sellers to collect and remit sales tax once revenue thresholds are met. This concept, called economic nexus, means even small e-commerce businesses may have multi-state obligations. International sellers may face VAT registration requirements in certain regions. Failing to register and collect on time can create significant back taxes and penalties. Finally, entity planning and long-term exit strategy connect directly to taxes. If you plan to sell your business in the future, capital gains treatment, asset versus stock sales, and goodwill allocation all affect how much you keep from the transaction. Early structuring decisions influence exit outcomes years later. Tax planning is not just about this year's bill, it shapes how wealth is built, protected, and eventually transferred. Owners who think ahead position themselves for smoother growth and stronger long-term financial outcomes.